In February 2020, the stock market hits an all-time high. Then, a month later, it suffers the fastest crash in market history. By April, 22 million Americans have lost their jobs in just 2 weeks, the worst economic collapse since the Great Depression. And then, the market goes up 30% in just 2 months. If that makes you feel confused, you're not alone. Most people see that and think the system is broken, completely disconnected from reality. People are losing everything, and Wall Street is celebrating. But there is a real explanation for this. Welcome to Martic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. Alright, let's get into it. The single most important thing I can tell you is that the stock market is not the economy. They're related, yes, but they are not the same thing. And treating them as if they are is the root of almost every misconception people have about finance. Here's the difference, as simple as I can say it. The economy measures what is happening right now and what just happened. GDP numbers, unemployment figures, consumer spending reports, these are all backward-looking. They tell you what the score was last quarter. The stock market, on the other hand, is a forward-looking machine. It's not asking how things are going today. It's asking what profits are going to look like in 6 months, in a year, or in 2 years. Think of it this way. The economy is the weather reporter telling you what yesterday's temperature was. The market is the meteorologist trying to forecast next week. By the time bad economic news shows up in the official data, markets have usually already processed it, priced it in, and started looking past it. Benjamin Graham, the investor who mentored Warren Buffett, put it perfectly when he said that in the short run, the market is a voting machine, and in the long run, it's a weighing machine. In the short term, markets reflect emotion, fear, hope, expectation, or panic. In the long run, they reflect actual underlying value. And when a real crisis hits, something counterintuitive starts happening with that voting machine. That said, let's explain 5 reasons why markets can rise while the economy is suffering, and some of them might really surprise you. The first one is simply what we just said before. Markets price the future, not the present. Imagine a company that makes restaurant equipment. A recession hits, restaurants close, sales collapse, everything looks terrible, and all of that shows up in the economic data. But what investors are really asking is, will this company still exist in 2 years? Will it recover? And if it will, what are those future profits worth right now? If the answer is yes, they'll start buying that stock before things get better. This is called discounting the future. Stocks aren't priced on what a company is earning today. They're priced on what investors believe the company will earn over time. So when things are at their worst and people start to believe the worst is over, that's when you can see markets turn around, even while unemployment is still rising. The second reason is that the S&P 500 is simply not Main Street. When people say the market went up, they almost always mean the S&P 500, the 500 largest companies in America. We're talking about Apple, Microsoft, Amazon, Google, or JP Morgan, which are enormous global businesses. Apple sells iPhones in China, Europe, and India. Microsoft sells cloud services to companies in over 100 countries. Roughly 40% of S&P 500 revenues come from outside the United States entirely. Now contrast that with the actual lived economy. Nearly half of all American workers are employed by small businesses: the local restaurant, the dry cleaner, the family contractor. None of those businesses are in the S&P 500, so when a recession crushes Main Street and Apple's sales in Asia are still holding up, the index goes up, or at least doesn't fall as much. The third reason is the Federal Reserve. The Fed has enormous power over financial markets, and one of its primary tools during a downturn is cutting interest rates and pumping money into the financial system. When interest rates fall, safe investments like bonds pay you less, so money flows out of bonds and into stocks, because stocks start looking like the better bet. Lower rates also mean companies can borrow cheaply, which is good for earnings. In 2020, the Fed cut rates to essentially zero and announced a $3 trillion asset purchase program. And they did it in a matter of weeks. Wall Street didn't just notice. They started pricing in the Fed's response before it was even officially announced. Traders call this the Fed put, the implicit belief that if markets fall far enough, the central bank will step in and support them. And that belief alone changes investor behavior during a crisis. The economy is collapsing, but the rescue is already being priced in. Crazy, right? The fourth reason is one that genuinely surprises people. It's not bad news that markets hate. It's uncertainty. Markets don't crash because things are terrible. They crash because no one knows how terrible things are going to get. In March 2020, the fear index, the VIX, hit the highest level ever recorded. Markets were in complete freefall. And it wasn't mainly because the economic data was catastrophic. It was because nobody could see where the bottom was. The last reason is harder to talk about, but might be the most important for understanding why all of this feels so wrong to so many people. According to Federal Reserve data, the wealthiest 10% of Americans own about 89% of all stocks. The bottom half of the country owns roughly 1%. So, when a market rally happens during a recession, the wealth it generates flows almost entirely to people who are already insulated from the economic pain. And it matters for how you interpret a booming stock market during a crisis. Now, I would like to end the video walking through 2020, month by month, because it's the clearest example of everything we just talked about in a practical way. January and February, markets are at all-time highs. There are whispers about a virus in China, but Wall Street isn't alarmed. Then late February, reports of community spread arrive in the US, and markets start falling fast. Through the first 3 weeks of March, it's full panic. The S&P 500 drops 34% in a matter of weeks, the fastest bear market in history. And then on March 23rd, the market bottoms. Here's what makes that date so remarkable. On that exact day, lockdowns are just beginning across the country. Unemployment hasn't even started rising yet in the official data. The actual economic damage is almost entirely still ahead. So why does the market stop falling on that specific day? Because on March 23rd, the Federal Reserve announces unlimited quantitative easing. Congress is racing to pass the largest stimulus package in American history. And for the first time, investors start to feel like they can see the shape of what this is. It's a pandemic. It's going to be brutal, but it has a shape now, and that matters. Through April and May, unemployment climbs to nearly 15%. Devastation by any measure, and the market rises 25%. Investors aren't ignoring the suffering. They're betting that it's temporary, that the economy will recover, and they're pricing that future right now. That's the pattern you see over and over in financial history. Now, I want to be straight with you about something. Markets aren't always right, and they don't always snap back. The 2008 financial crisis is the counterexample. The S&P 500 fell for 17 months, not just some weeks, because the uncertainty around the banking system, whether major institutions would survive, whether credit would freeze entirely, went on and on. The shape never quite clarified until it did, very late and very painfully. And there's a broader question worth sitting with. Even when markets recover correctly, does that recovery reach everyone? The honest answer is not automatically and not equally. A rising market doesn't mean rising wages. It doesn't mean small businesses come back. It doesn't mean communities that lost jobs in a structural downturn suddenly bounce back because the S&P 500 hits a new high. Markets are a sophisticated tool for pricing future corporate earnings. They don't even reflect clearly how most people are actually doing. And that's all for today. I hope that you found the video helpful, and don't